Okay, let me now bring on board Jyoti Jaipuri, Head of Research with Bank of America ML. And Jyoti, good morning. Thank you for joining us. Jyoti, irrespective of what we will get from Reserve Bank of India today, do you think Indian markets are headed higher? Because earnings have bottomed out, there is abundant liquidity, and policy reforms have kicked in.
Yeah, but rate cuts and reforms are the two pillars, I think, on which the markets will perform over the course of this quarter. And hopefully both won't disappoint us. If we don't get rate cuts, markets are positioned for the rate cuts. So if we don't get rate cuts and the commentary is negative, then there could be a pullback in the market. Because today, everybody is going in with a very consensus view that a rate cut is definitely coming.
But Jyoti, if we don't get a rate cut today, what kind of collateral damage do you think that will do to benchmark indices? And if markets correct today, would you be advising your clients to buy into that selling?
Yeah, see, if you don't get rate cut, it's like, I think what is more important is the commentary around it and what is the guidance they give for the future. Because ultimately, yesterday, if we see, the release which came out, it indicated that, yes, growth concerns are there. Inflation is starting to ebb, though, it has not come down low enough to start maybe a series of rate cuts. So to that extent, I think somewhere along the course we have to see rate cuts. Most probably, I think we are expecting it today, and I think so is everybody else on the street. So I think there'll be a big surprise if it doesn't come today.
Jyoti, a large part of the rally of 2012 was attributed to the kind of FII inflows that we saw. Year to date, we've already pumped in about $3 billion. Do you think there is a case that perhaps 2013 may be a better year, at least the first half, as compared to 2012?
Yeah, see, like what 2012 was, that India was probably not doing well in terms of the economy or in earnings, but at the same time, neither was anything else in the world. So on a relative basis, people were hoping that in India, things were starting to bottom out. At some point, we'll start seeing rate cuts. At some point, we'll see government reforms. If you see a lot of the market last year, the returns came in only a few months. So it was like a very patchy market where things were stagnant, and then there was a couple of months which gave you bulk of your returns for last year. This year we'll see a lot of that hope translate probably into reality, where we are seeing reforms anyway which are starting to accelerate. We're probably going to see rate cuts come through, and we'll see some numbers which start to look better. So it is like how much has the market discounted this good news, and at what point market starts saying, okay, now valuations are probably discounting a lot of this, but we are not getting, let's say, a recovery as fast as we thought, or if at some point the reform starts stalling as we move closer to the end of the year. The other thing to remember is what happens to the rest of the world, because for most of the FIIs, India is one of the countries, and India does well, but if the rest of the world does better also, then people may start thinking, okay, should I move a bit of money away from India, which has done well, into some other country. So a year ago, India started the year as one of the worst performing markets, because 2011 India was, I think, the third worst performing market. This year, India is starting as one of the best performing markets of 2012. So that at some point, tends to create a bit of problem in terms of how high the markets can go.
Jyoti, whereas large cap stocks are holding on, are you a bit nervous about market internals? The way mid cap and small cap stocks have suddenly caved in last 2 weeks, what does that indicate?
See, we've had a good rally. So ultimately, if we step back from September, when the reforms started getting announced and when QE3 was announced, markets have had quite a sharp rally. So to that extent, everybody thinks maybe we'll get a pullback. We are getting closer to the budget. So typically, if we see history of markets are sold off, some time before the budget, as people want to book in a bit of profit ahead of the event. So I think, over the next 3-4 weeks, we probably have markets which move a little higher, and then we start to pause and get a bit of correction coming through.
Jyoti, if a Sensex target is at 21750, we currently are at about 20,000, which means you don't see an index upside of more than 5-6%.
Yeah, I think this probably gives close to 10% from where we are today, which our whole thing was premised on this year. We think earnings growth would be roughly 12%. We've seen last year most of the returns came through re-rating. It didn't come through earnings growth. And we think this year the re-rating may be difficult, especially as we move into the later part of the year, because the focus of investors in the last quarter of this year will move to the 2014 elections and what shape the new government would take. So to that extent, we thought that it's more like you'll probably get returns which are more or less in line with earnings growth, which is around 12% for the year. So that's where really our premise is based on.
Jyoti, what is it that you're liking amongst the rate sensitives, in particular banks? Any of the mid-cap PSUs interest you?
Yeah, so in banks, like, it's been a mixed bag. Last year it was only private sector banks which we liked. Now actually we've moved our portfolio a bit towards the public sector banks. We like public sector banks over the next 3 months, 6 months as a trade, because they'll benefit the most if NPL fears start to ease off a bit. They benefit the most from a rate cut and from a bond yield which starts to come down. So we have moved into some of the public sector banks, and we continue to like those. There are some private sector banks which are mid caps which we have played for the last 2-3 years, because these have been just you're trying to find the next big bank in India which comes up, and there are some NBFCs which we have played. So it's been quite a mix. We have played in the whole banking space.
Jyoti, do you think we are on course to hit a new high well before budget, or markets will wait for the budget? They would want a strong budget before we can cross over that hump of 60-100 on the Nifty?
See, I guess we're not too much away from the high. So from my point of view, like a 2-3% move, 4% move is not something which is very material in terms of are we hitting a high or not. It's what sort of return can we get for this year? Do we really beat bonds again in a substantial way, or we don't? Because to get retail investors back in the market, I think they want to see a couple of years where equity really outperforms the debt market.
At a time when discretionary spend is coming under pressure, the kind of commentary we've got from Mahindra and Maruti, at least the management commentary, is not all that rosy. Why are you bullish on autos, and especially four-wheelers?
Yeah, so like if you think about autos, what you have is a scenario where there was a lot of uncertainty in the economy. Economy was doing badly. At the same time, interest rates were at a high level, and demand started to slow down. A lot of these factors are now going to change. So basically, hopefully the economy will do better this year than it did last year. Interest rates will be lower than what they were last year. And these are the signs which start to, lead to a revival in demand. Now, most of the time the stock market and the shares go up faster than the revival. It does not wait for the revival to actually flow down to the numbers. So the numbers might change only 6 months and 9 months down the line, but by that time you'll probably find that the stocks have anyway had a decent run because they were anticipating this sort of numbers. History has been that quite often stocks over anticipate the recovery, and then when actually the numbers start to look better, the stocks start to stagnate, because they probably over anticipated the sort of rebound we could see. So you have to buy these things in advance. You can't wait for the numbers to start getting better before you buy it.
Jyoti, is that the assumption with real estate too? Stocks moving faster than real on-ground recovery?
Yeah, that's it. Like, ultimately when you get the rate cuts, two things happen. You have to buy the companies which are heavily indebted, because, those are the companies which make the biggest difference to the EPS. Like, there are lots of companies in the infra and real estate space where the 100 basis point rate cut would mean like a 30% jump in EPS. So, you have to start anticipating these and say, what do you buy? Because last 2-3 years have been years where people avoided all the high debt companies. They only wanted the free cash flow companies. When rates start to come down, it's no use like buying the free cash flow companies, because they probably may lose out with the interest rate cut, because they are sitting on net cash on their books, and those may earn a lower income than they used to. Whereas it's the companies which are sitting with a high debt, where things will start to improve in terms of earnings, lower interest costs. Secondly, for real estate, again, if you think of the end product demand, it is linked to interest rates, it's linked to the economy. Once people feel that, yeah, my economy is getting better, my job prospects are looking better, and they get a cut in interest rates, people are more willing to go and buy a house. So both ends, like whether it's the demand or it's your cost, you probably benefit from a rate cut.